Well, good morning, everybody. Thank you for coming. Shout out to everybody for hanging in there through Wednesday. And a big shout out to Aaron Lubitz. Aaron put this panel together. We always do the institutional investor panel on Wednesday. And really the credit goes because we have a lot of different funds, and I think you're going to enjoy that. Not just pension plans, but a whole variety of people with different plans and different objectives. And I have here the course, the plan for GDP for 2025 and 2026. This one was written in December, so get rid of that. Thankfully, I have another charting the course. This one was written in early February after Trump, and everybody knew it. But of course, this one too, yeah, it's gone. So, and a cute story. This is a fun town, being in Beverly Hills. My wife is here, and our anniversary is coming up, so I thought I would do something special, and I rented a limo last night. And $300, like, okay, that's kind of pricey. But then it showed up. It didn't have a driver. And I thought, here I've spent $300, and I've got nothing to show for it. Thank you. Thank you. I'll be here all week. You know, I have some jokes about oil drilling, but they're boring, so I won't tell you. Okay, so I will stop there. With me on the panel, Justin Barton from UCLA, go Bruins. Jenny Chan from Children's Hospital in Philadelphia. Edwin Denson from SWIB, as we like to say, state of Wisconsin. Jonathan Glidden from Delta Airlines, and Guadalupe Rodriguez from Telepot. So what I want you to do is go down, we'll start with you, and describe for us not just your fund size, where you're located, but what is your liabilities? What are you aiming for? What's the goal of your plan? Because I think for each one of you it's very different. So, Guadalupe?
Good morning, everyone. Buenos dias. My name is Guadalupe Rodriguez. Many people call me Lupe. If you're in the South, it's Lupe. We are a single-family office of a Mexican family. We're based between La Jolla, California, and Mexico City, with our back office in Culiacán, Sinaloa. Very similar, Chris, to what you just did to your piece of paper is where we are in terms of how we're thinking about things moving forward, especially given last week's events in Washington, D.C. between the private sector, the public sector, and everyone in between. And yesterday, or day before yesterday, Secretary Besset's comments. So I'm actually here expecting answers from everyone else.
Good morning, everyone. Delta sponsors both a defined benefit and a 401k plan. The defined benefit plan has been frozen for 20 years. It's also 106% funded, which is a pretty unusual, kind of combination, and it opens up some interesting conversations for both Delta and for our participants in the way of retirement readiness. So we're kind of at that point where it's very, I won't give you too much pension stuff, but we're 106% funded on a GAAP basis. If Delta has to make a contribution, that's a different funded status, which is 100.5, right? So if it's below 100, there are mandatory contributions. It's above 100, there's not. So it's very important that we generate returns. So we want to generate, these are our objectives. I want to make a 7% return, like every year. In 2025, I want to make 7%. I don't want to lose money, and we want to keep our GAAP funded status nice and high. So that's a lot on the defined benefit side. On the 401k plan, that's about $35 billion. DB side is $15 billion. 401k is $35 billion. It's pretty plain vanilla. We default into an age-appropriate target date fund. It's got a pretty standard glide path associated with it. And I would say we do feel constrained by litigation risk in the 401k space, so it's largely passive. We do manage to squeeze a little bit of active management into the target date funds, but we really try to keep the expense ratio below 10 basis points, right? So we'll talk a little bit more about Delta employees and retirement readiness as we get through the program. But that's when we survey our employees, that's what comes back as the worst. It's not awful, But for non-pilots, Delta will put in 3% into the 401k plan and then match dollar for dollar for the next 6. So if an employee puts in 6, Delta will put in 9 to get up to 15. That's where we want people. But people still don't feel very, broadly speaking, don't feel very confident about their retirement. And we'll circle back on some of these comments.
Thank you. Edwin?
So the State of Wisconsin Investment Board manages the pension assets for the Wisconsin retirement system. It's a defined benefit plan covering almost all of the public sector workers in the state. So we have about 700,000 members, and we manage around 140 billion in those pension assets. And in terms of always keeping an eye on the prize, we need to deliver 6.8% over the longer term to keep the system stable. So we're very focused and concerned on that. We are fully funded, and part of that is the reason is explained by a rather unique feature of our plan design, and that is what we call risk sharing. So when our active members decide to retire, they are simply promised a fixed nominal level of a benefit payment through time, so there is no COLA. However, if we perform very well on the investment side, so if we, on a 5-year trailing basis, provide more than a 5% annualized return over that period, the benefit levels actually go up. But by the same token, if we underperform, that benefit level can go down. However, nobody can ever be reduced before their floor or their initial annuity. And again, that's the risk-sharing nature of the scheme and plan design, and that's one of the things that helps keep us fully funded through the gyrations of the capital market cycle.
Well, and kudos to you, because you're one of, maybe 3 statewide pension plans that are fully funded, maybe only 2 in the whole country. So credit you guys. It's a very unique structure. Jenny, what about the hospital?
At the Children's Hospital of Philadelphia, the long-term pool is approximately $3.4 billion these days, and we really act as a ballast for the financial health of the hospital. We've got a AA credit rating that's very important to us, and we want to make sure that we're able to provide the financial support for the entire enterprise to do research and innovation and help sick kids get well.
Awesome. So Justin?
Sure. Last but not least, so UCLA Foundation has about $5.5 billion. About 4.5 of that is endowed assets that we manage in our office. Little bit about UCLA for those in the audience. I'm sure many of you know where it is, but it is the #1 applied to school in the country. It's the top-ranked public university in the country. We have about 45,000 students on campus, but it's not just a university, it's also one of the top hospitals in the country as well. It will actually be the Olympic Village at the upcoming LA Olympics. And given a lot of the content here over the last week, I thought an interesting fact about UCLA is it's actually the first site of the first internet message that was sent in 1969, a little Department of Defense project called ARPANET, and some professors sent from a computer at UCLA to a computer at Stanford a message, and that became Node 1 and Node 2 of the internet. So,
wow,
an interesting kind of history. Like half a century later, I'm sitting here listening to panels about how like Skynet's coming and we're gonna, computers are gonna take over the world. But we have a very easy, quote, easy objective, which is we need to do a 5% real rate of return into perpetuity. That's obviously more difficult in a situation where inflation is higher or interest rates are lower. And so we'll probably almost always have a very equity-oriented portfolio.
Well, and in perpetuity, let's think about how long that is. So, we had a plan, now it's gone. Let's talk about each of you with your time frames. Where are you comfortable forecasting? What do you, how are you going to navigate in this world? Edwin, I'm going to start with you in the middle.
Oh, sure. Well, it's ostensibly we're supposed to be investing for the long run. It's sort of an ambiguous statement, but the 30 to 50 years, that's how far the actuaries run their stress tests of the system out. But realistically, I think we can only hope to remotely know what the world is going to look like 5 to 10 years from now, so that tends to be our planning horizon. And with what's going on right now, it's wait and see, because it's really not worth it from our perspective to make major changes in asset allocation in an environment like this, because you could end up just sort of be chasing your tail. So until we really know what the final policies look like, not just trade, not just immigration, but also tax policy, it's just difficult at this point in time to really move one way or the other with any conviction.
So you're lucky because you've got one big pool of assets.
Yes.
Jonathan, you have two distinct groups. You've got a frozen DB with a focus liability. Then you've got DC participants. How are you changing, or what time horizon, how are you working with that?
Yeah, let's start on the defined benefit side. So the easy answer to the question is the duration of our liabilities is 8.5 years. Yeah. So that's kind of one answer to the question, but there's another answer to kind of get to somewhere around that range. Delta faces kind of a barbell decision right now. Not necessarily mutually exclusive, but again, we've been frozen for a long time. We're overfunded today. So I'd say, kind of the two endpoints of the decision that's facing Delta today is one, let's package up some of the assets and some of the liabilities in the relatively short term, and let's enter into a risk transfer agreement with an insurance company. So in that case, that's really going to kind of shorten the duration that we're thinking about in terms of the assets. That's one path. The other path is to kind of think about things more in perpetuity as well, and to generate a larger surplus and see if there's ways to use that surplus to benefit Delta's employees, and Delta is the plan sponsor as well. In that case, it becomes a multi-decade period kind of time horizon. So one, you got really short, the other one is kind of long. You kind of mix those together, you still end up at about that 8.5. What does that mean practically? We're pretty much at the end of our glide path at this point. It's a little bit different at Delta than at most places, but we're 30% private investments really across the spectrum. We're 40% hedge funds. We've got some inflation-sensitive assets, and we trade really a beta overlay that's primarily fixed income to kind of hedge our liabilities at this point. We've got to be very thoughtful about what we do on the bond side. So that's the DB. You've got a little bit of everything. We try to shoot for the middle, really try to generate alpha, and we've got to try to stand ready to either engage with an insurance company pretty soon or really try to maximize the value of a surplus over time. 401k, again, you kind of default into a target date fund, and you guys probably know what those look like, right? So they tend to be 99% equities when you're young. Define that as until when you're 40 or 45 or so, and then it'll go from 100-0 to more of a 40-60 kind of portfolio. And a lot of that's on autopilot, right? So we think hard about, does the target date fund, does it kind of fit our population? Can we add a little bit of excess return within the target date fund? We do have an active tier, and our only goal on the active tier is to beat benchmarks.
Lupe, how have you changed your perspective from the family office with this kind of volatility?
Sure. Well, I appreciate being part of this group. I think that the family office space is one that is no longer up and coming. And how we think about it in the family office space is more about generations, not quarters. So we already have the competitive advantage that we're thinking about and working with the following generations in terms of how they're thinking about things. So taking that perspective, and the fact that I'm very lucky to be working with a very innovative, forward-thinking principal, we have the luxury of being able to take a step back and think about how the investments that we're making are not just going to give us return for the short and long term, but how are they affecting the societies that we're building. So we get to take a little bit more time, and I think if there is one message that I would want for all of us here at Milken to lean into is when I was a kid, I lost half of the little pieces to one of our board games, and I never found the instructions. So we made it up ourselves, and we made up our own pieces, and that's how I feel that we are right now. We collectively get to make up some new pieces, and decide how it is that we're going to engage moving forward. I think it's very dangerous just to continue to look at the how has it been done.
Gotcha. What's changed at UCLA? I mean, in perpetuity and a 5% real now is like an 8. So what are you guys doing?
Yeah, you know, when you mentioned roadmaps, the first thing that popped in my head was roads, Chris. Where we're going, we don't need roads.
Nice.
No, I think, look, and staying with that sort of metaphor, having a North Star is really important when you're running really any pool of capital, but especially an institutional pool. And so for us, you know, looking at that strategic asset allocation and identifying what your core strengths and weaknesses really are. And so for us, look, everyone gets swayed by what's happening, you know, real time in the market. But ultimately, we really should be thinking in terms of decades with our type of capital, right? We look at it as we're managing, you know, assets and taking care of students today, but also our students' grandchildren. And we've got to balance that. And so really it is about, look, our advantage is that time horizon. Being able to maintain sufficient liquidity to meet those obligations, take advantage of dislocations when they happen, but really falling back on what is, you know, what are your long-term targets? What do you expect to do through a long period of time? We've been around a little over 100 years. You know, hopefully we'll be around hundreds of years more. We'll go through all kinds of different economic environments. And, you know, I think that's where we can take advantage versus trying to compete with, you know, all these incredibly smart people that are reading, you know, what's readouts of, you know, payrolls this week or next week. So, you know, we haven't really changed too much. Continue to execute on, you know, the same strategy, and I don't think we'll change terribly much over the next 3 to 6 months.
Everybody's staying to the long term. Jenny, how about you guys? I mean, there's got to be worry about how medical funding for medical research is going to ebb and flow. Will that impact you? Is that changing your asset allocation?
Well, it's absolutely impacting us. You know, CHOP was founded in 1855, and I always have that in the back of my mind when I think about time horizons. You know, we don't necessarily have the same luxury of time that we might have had even a few years ago when we think about our ability to invest in illiquid investments, for example, and kind of we started down that roadmap, which is hard to pivot from in some ways. Having said that, you know, we came into this year with a good amount of cash because we knew that there would be challenges. The business of healthcare is quite complex, and even though I've been with the hospital for 6.5 years, I feel like I'm still just scratching the surface of that, particularly with all of the developments in 2025. And so we are certainly thinking a lot about coordinating with our departments across the hospital the issues of grant-making funding that we get. Those are critical parts of our business. So I think it was 2021 when Adam Grant came out with a book called Think Again, and that's what we're doing a lot of. We're testing ourselves in terms of, are we asking the right questions? Are we asking better questions? You know, who are we having conversations with that force us to think more about our blind spots and make better decisions? So while we don't have any full-scale changes in asset allocation because we've intentionally created a model that is very flexible, when we are thinking about what's happening in the next 2 weeks, the next 2 months, the next 2 years, we do have to approach it differently.
So everybody's going to just take the long term, which I appreciate, kind of ride through this. In this environment, though, we're seeing some unique shifts. Obviously, changes in the dollar. We've heard a lot of comments about weakness in the dollar, where that will go against the euro, other currencies. And then for all of you, you're U.S., non-U.S. So give us an idea of, are you going to change your position in terms of FX? And are you going to change either your equity or just your portfolio weighting of U.S. versus non-U.S.? So Jonathan, why don't you tell us about your two worlds?
Yeah, so you know, we've been forced to kind of think about these things for a while. Now, I will say, I do feel like a regime shift is underway in the investing world that could weigh on the returns of assets and on bonds and drive a positive correlation between stocks and bonds. But I've mentioned as I went through the objectives, objectives, I want to make 7% this year, I want to make 7% next year. That's had an impact on the way that the portfolio looks. And I walked through the asset allocation a little bit. We've got a 10% allocation to public equities. That's it. And that's by design, right? Because equities come with a lot of volatility, and even if you like equities, there's a chance that equities could be down pretty substantially. So we don't rely on equities that much for our return. We do have privates. And I think Chris has got I don't know which versions he tore up over there, but there might be a question on privates coming up. So, I mean, there's still economic exposure that comes through the privates. The biggest thing that we're doing as a result of kind of some of the events in the world is really thinking through our fixed income portfolio. Fixed income is important for a corporate pension because it helps us manage our liabilities and manage what we call our funded status volatility, how much different our assets look from our liabilities. We're actually willing to take a little more variability with respect to our liabilities today, because if we find ourselves in a stagflationary world, that's going to drive up yields and that's going to drive down the return on assets. That's our biggest single risk factor. We look a little bit different from a lot of folks on that, in that equities is not our dominant risk factor. It's actually interest rates that's our dominant risk factor. So we have brought down our asset duration a little bit. So we've kind of moved out of, this is at the margin, right? We've moved some out of long duration treasuries. We've moved some out of 10 to 20 treasuries, kind of into 1 to 3 treasuries. We've diversified our treasury exposure by putting in some mortgage-backed, kind of exposure there as well. And even on the private market side, and this is a very slow-moving ship, particularly in today's distribution environment, we're trying to bring down private equity a little bit. We're trying to bring up private credit a little bit. And when it comes to the 401k, it really is. It's the predetermined glide path of the target date fund. We don't deviate from that. We don't trade tactically around that. But that could be. I would love to hear thoughts from the audience if there's a better way. Is the primary retirement vehicle for folks in the future. But that's Delta.
Well, as you said, you're worried about lawsuits. You want to stick with the crowd. And I want to point out, they put that up on the screen a minute ago, the QR code. The panel is going to allow time for questions for Q&A, and I'll have the iPad up here. So feel free to scan that and fire up some questions. Lupe, you guys, I assume, are based in a base currency of the peso. How are you looking at the dollar and
No, sir,
and
we
FX?
are not.
Yeah.
Yeah, the big difference between the family office and perhaps the holding companies.
Okay. But how are you looking at your global exposure in terms of, are you changing the weighting away from the U.S.?
We're not shying away from the U.S. The United States is still the United States, and we expect that it will continue to be the United States for the foreseeable future. Where we've shifted is really looking at structured deals and cash flow assets. We're also focusing on things with deep trends that are bringing together technologies with geopolitical issues. Think border security, supply chain, nearshoring. So we see it less as a nation-to-nation perspective and more of how is the globe shifting in terms of how things are shifting products and services.
Gotcha. Justin, how about you guys?
Yeah, so I guess two areas. Look, we've always had probably, I would call it a 60-40 split between the U.S. and non-U.S., which is kind of close-ish to what global equities are, but it's not really, I would say I'm aware of that, but we're not necessarily targeting one shift or another. But I think if you dig down a little bit deeper into it, what we end up with is a pretty significant overweight to non-U.S. equities in our public equity portfolio. Where
And did you have that coming into 25?
We've had that for about a decade plus, as long as we've had the endowment. But that's or the investment company. But again, that's in the public equity portfolio.
Yeah.
But I look at it as a total pool where we pick up a lot of U.S. exposure in our private markets and illiquid assets. And we just think that Like the US is a much deeper financial market with a lot more kind of tools available to us in more kind of esoteric financial products that we can't get necessarily in the same way in Asia or Europe. But the US equity market is a lot more efficient. There's a lot less opportunity for alpha, so we'll spend our sort of time and effort in public equities in non-US markets. I think just touching on some of the things that other panelists have said, one of the things I said at the start, we're always going to have a pretty significant bias towards equities in our pool. However, again, when rates are getting a little bit higher, if we can start picking up returns that are, attractive enough for our hurdle rate, once we get above that hurdle rate, a low volatility is really important to us because we're paying out every quarter. So we've done a lot in the last couple of years in the credit and fixed income space. A lot for us, meaning going from almost 0% of the endowment to probably in and around 10% or so has been into those where we're picking up our required rate of return higher up in the capital structure.
Fixed income has a return. Jenny, how about you?
So I think it's a really exciting time to think outside of the U.S. And historically, we have been quite U.S. biased in exposure in the portfolio. Potentially, we are in the midst of a regime change, and that often can bring interesting opportunities. So I think we're revisiting kind of relationships with non-U.S. partners that we've known for a while, and more interested in having conversations with ones that are new with different perspectives. I think the opportunity set has become more interesting than certainly I've experienced in recent times.
Edwin?
Yeah, I'll answer. It's got a three-pronged policy, then maybe some things we've been doing tactically, and then private markets. So before I joined SWIB, it had made the decision to eliminate the U.S. home bias in the public equity exposure, and all of the non-U.S. exposure was unhedged in terms of the currency hedging, and that didn't look like a very good decision for many, many, many years. But that's really worked in our favor, particularly over the last 3 or 4 months. So it's on the policy side. On the more tactical side, again, not predicting what was going to have actually happened at the beginning of this year. We had been carrying modest underweight to U.S. public equity for valuation reasons, and had also been already leaning a bit against the dollar. And again, both of those have really helped us in the last 3 or 4 months. And then I'd say on the private side, and private equity and private debt, compared to sort of a global index representing those asset classes, we kind of had always been a bit overweight Europe and the U.S. at the expense of the other part of the rest of the world, which is Asia. And in the current environment, we're taking a closer look at actually increasing and exploring the opportunities in Europe.
Okay. So one of the big changes that has happened, obviously with all the turmoil about universities and taxation and different things, for whatever reason, Yale put up a slice of their venture capital portfolio for sale in the marketplace. I've heard it sold, but I haven't heard a price. But my question to you is, a lot of us, when I ran CalSTRS, we had a very mature private equity portfolio, which meant we had a big long tail of very late old funds that we always debated. Should we leverage it and sell it? Should we keep it? What do we do with it? But, with Yale and maybe Harvard selling a slice of their venture portfolio, are you a buyer or are you interested in selling? And obviously it depends on the price, but where are you with your private allocation and how are you thinking about changing? Jenny, let's start with you.
So we're kind of totally around a third private in the portfolio, mostly in private equity. I think it's really interesting to kind of see these transactions come to market. I'm quite anxious to hear about the pricing of some of them, and I think it just creates more activity for the rest of us to consider as options. So we're not buyers necessarily at this time. We might be sellers, if anything. But I've been thinking about secondary sales in the portfolio for quite some time and never have not quite gotten there yet. So we'll have to see. There are other levers that maybe priorities that we would do first, but it is quite an interesting development.
So Edwin, I heard you put a bid in. Did it get hit?
Not sure. So, background, we've been on a strategic path to meaningfully increase our footprint in privates from where we were 5 or 6 years ago. One of the keys, of course, to risk managing that is to have vintage year diversification. So with what's going on, we haven't really been altering our commitment paths meaningfully. And yeah, at the right price, we're buyers at this point because we're still not quite at our aspiration in terms of our total private exposure. We're currently at about 30%, and we're looking to get to what we would think would be an equilibrium somewhere between 33 and 35%. So,
Okay.
yeah.
And Jonathan, I mean, the DB, you said you're a little bit of everything, so I assume you do have some private equity in there. Would you be a buyer or a seller?
Yeah, so I'll start out with, I'm still a believer in private equity. I don't think U.S. private equity is going to be immune if there's kind of a re-rating of public equities, but I think obviously there's been a flood of money in, and we know that there's a lot of kind of increasingly retail money that's coming in. That'll probably erode some of the excess return that we've seen from privates over publics. But I still think private equity is going to do well. I think private equity does better than private credit, maybe not as much better as it has in years past. Still a believer in private real assets as well. Now you kind of run into some of the pension dynamics that we talked about earlier, which is there's a chance I'm going to have to engage in a transaction with an insurance company. Insurance companies like to match liabilities. They've got a lot of regulations that require them to. So what do they like? They like cash, they like physical bonds. What do they not like? They really don't like private equity. They don't like private real asset kind of stuff. So I'd either have to take a discount on pricing from the insurance company, or I'd have to engage in a secondary transaction as well. So we've got to think pretty long and hard. One of the factors, it didn't used to be the case, but one of the factors we have to use now with our private market commitment budget is what do we think the resale value is going to be? And what Chris is talking about, on the CalSTRS side, the long tail, the really old long tail, that gets terrible pricing, like almost regardless of what the environment is. You're talking 65, 70, 72 cents or something like that. Venture capital also gets lousy pricing pretty much consistently. Sometimes it'll be better than others, and yes, it depends on the quality of the portfolio and some of the brand names that you might be able to sprinkle in there. But we invested in LP secondaries for a very long time. 2025, we had to stop because the resale value just isn't there. That'd be too big of a hit. I think there's something to be said for running a private portfolio as long as you can, harvesting that premium as long as you can, and if you've got to sell a high-quality private equity portfolio in the secondary market for 90 cents, 87 cents, I think maybe that works, but we're definitely not a buyer today. A little bit unfortunately. It's nice, right? I want to make 7% this year. The nice thing with secondaries, you buy at a discount, you get to monetize that discount as soon as you bring it on your books, right? So it's nice that kind of you get a sugar high from that. I would love to be a buyer. I can't be, but I sure hope I'm not a seller either.
Yeah, and sugar highs don't last a long time, though. That's the challenge.
I'll worry about that next
What about
year.
you?
So we're huge proponents of private capital, venture capital, and private equity. In the private equity space, there are a couple of firms that are offering a slightly different take to private equity. And because as many families, we're still operators. And so when you look at who are you going to sell your company to, private equity is really the only option. But for operators, it's not generally the best option. So there are a couple of groups, one that was spun out by Tracy Britt, who left Berkshire, another one called Cranemere out of New York and London. And they're offering a really interesting model for a private equity-like play. So we're participating there. On the venture side, we actually spun out our own fund called 1200 VC in order for us to merge together some of the things that we've been talking about. From the Gen Z perspective of what they want to do, what kind of a world they want to build, what kind of companies they want to invest in. From the principal perspective, who's very much a believer of very traditional business models and companies. So we have decreased our amount of play in the public portfolios and continue to increase in the private markets. We also take pride in being a value-added LP where we play a lot of hands-on roles within the industries that we invest in. So we believe the future is in the privates.
Well, certainly a huge percentage of the market is now private. Justin, how about UCLA? What do you guys do?
Yeah, I mean, so a couple things on the private side that I think are worth touching on. Just at a very high level, not every asset class has a very different sort of characteristic, right? So not all privates are the same. An early stage, seed stage venture capital fund's going to have a much, much, much longer duration than private credit or something like that. So I think we can manage, if we have a very diversified set of asset types, close to 50% of our assets in drawdown vehicles. But that's with a target of, let's call it about a third in private equity and venture capital. We're in a different, and I'll come to the secondary piece as part of this, but when I speak to a lot of my peers, we're in a very different situation than when I speak to them, in that this year in our private equity portfolio, and we're on a June to June fiscal year, we've actually seen more distributions than calls.
Oh, good.
In our private equity portfolio across illiquids. We've got about a 40% increase in distributions year on year. And we're getting distributions that are somewhat on the order of what we saw in 2021 and 2022 for the fiscal year. So we don't quite seem to have the same liquidity challenges that we're seeing other people do. Part of that, I think, is we have a pretty idiosyncratic approach, and we're looking at a much smaller section, at least on the private equity side of the market, than a lot of our peers. We're typically focusing on private equity firms that are buying sub $10 million EBITDA businesses, which is a very different risk profile. But when we see these secondary transactions, to me, it feels a little bit like we'd be the dog chasing after the car. Like, I don't know what we'd do when we actually catch the car, because most of the things we see there in the secondary market are portfolios of managers that we're not necessarily targeting.
Yeah.
And so we don't really know those companies, those portfolios. Why would we be buying it? So that's kind of the way we look at it.
I think that was our big concern all the time. It was a proliferation of names. All of a sudden, we have that many more, and that's a lot of legwork. Let me go down each of you. When I look at this plan that we had 2 to 3% GDP forecast for 25. We thought everything was going to be slow. It was still the Mag 7, but the bloom was off of those stocks starting in late December. Now all of a sudden we've had a negative quarter of GDP. We've had, at least so far since Liberation Day or whatever it was called, very little activity commercially. Now you have another month where there's so much uncertainty, so I'm not seeing any M&A activity. Companies are not making any long-term decisions. I've heard different forecasts here at Milken about what second quarter GDP will be, but how have you had to shift in terms of, you're having a long-term focus, but right now we have a lot of things in front of us before we get to June. You got to pass, let me get this right, this way, the big beautiful bill has to be passed now. I thought it was May, now apparently it's 4th of July, so the deadline moves. You've got 70 treaties to negotiate. I guess they claim 15, 16 will be announced shortly. As Edwin and I were talking, those are going to be MOUs at best. We agree to talk more. I don't know how that's a trade agreement. When I look out at that landscape, I don't know what to do between now and June. Are you just sticking to the long course, or anybody making a portfolio shift? Lupe, I'll start with you.
We are not making a portfolio shift. We've been operating under these circumstances with things shifting outside of the U.S. continuously. We've had more experience with this type of volatility in other places, where we are kind of waiting and seeing is what do my colleagues do? Because what they do, what's happening that you described at the universities, well, that's going to put in an entire new group of opportunities into the market. So we'll wait and see.
Jonathan, you undeterred?
No, definitely deterred, right? But again, we've de-risked the portfolios quite a bit. I walked through some of the changes we've made earlier in terms of bringing down duration a little bit, kind of diversifying the bond mix a little bit. But we still need return, right? We still need return now. We need return next year. So I've increased kind of the percent chance of a stagflationary environment. So is there stuff that does well in a stagflationary environment? Historically, precious metals have done well. I mean, obviously, gold's been on a tear for 3 years. Maybe it's a little bit overdone at these levels. But, broadly speaking, if we do find low growth, high inflation, precious metals tend to do well. Infrastructure investments tend to do well. Kind of stuff tends to do well. Residential real estate, some pockets of commercial real estate. I know this time's a little bit different around there. So, we are trying to shift a little bit more into assets that could benefit from a stagflationary environment, and a lot of that's kind of based on the lending side as well. So, infrastructure lending, resi lending, commercial real estate lending, maritime lending, aviation lending, NAV lending on funds that do this kind of stuff. We do effectively run a levered portfolio. Our asset allocation sums up to 140%. So I don't think it's a good, I think it's probably a good time to cut the amount of kind of leverage and exposure that we've got to things that will, really struggle in an economic contraction or below normal growth environment. But I think there's room for us to kind of increase a little bit on real assets and lending behind real assets.
Edwin, you've had the ability to add leverage. Are you backing off? Where are you at?
We're taking a wait-and-see approach, but we have a lot of flexibility with what we do, both from the bottom up and top down. So we're just looking for dislocations, because we don't know what will happen between now and the end of June, or even I think further on from that. And that's just kind of historically what we've done. Again, from the top down, stand ready to take advantage of any major dislocation from an asset class standpoint, and then rely on our internal active managers and our external managers to take advantage of any kind of dislocation on an individual security basis. And everybody has that flexibility to be able to react. So I'd say we're just more in reactive mode at this point.
Yeah. Jenny?
So we have a quarter of our portfolio in passive equities, and I think while we are not spending time trying to be predictive ourselves, it's been really fascinating to hear from our managers how they are factoring in and modeling potentially, changes in the impact of tariffs, and I think it's a real test for the opportunistic folks to prove that they're really opportunistic, and time will tell, right, where the dust settles, but there will be clear beneficiaries, I think, and then those on the other side, and that's what we're kind of spending our time on.
I'm a terrible market timer, so I've just asked all my AI models to tell me what I should do over the next 2 months. That's fine.
Every time I ask them, it says it can't predict the future, but it can identify trends.
No, I think, so we think of ourselves as asset owners. My team hears me say all the time, I want us to make sure that we're underwriting, whether it's private or public, things with cash flows. We can't control where price goes, but if we're good business analysts through our managers, but also understanding what our managers are doing and how they're thinking, that's the best guard we have against uncertainty, because even if the price of those high quality businesses are going down, if they are anti-fragile enough as businesses, they will be getting stronger in that environment. So again, it's more trying to look through and really understanding what you own and why you own it, more than, again, trying to predict. Like, there are some people who get macro really, really right. It's definitely not me. It's definitely not our team. And we're not going to sit there and try and compete with people who are good at that.
Gotcha. Well, I've got several questions here about hedge funds. So let's do some rapid fire. Tell me if you have a hedge fund, an allocation to hedge funds, how much a percent of the assets, and are you going to be adding to that, subtracting, or holding steady? Lupe, let's start with you.
We don't invest in hedge funds.
And any interest or still nothing? No, not a buyer.
Not a buyer.
Yep. So I mentioned that delta from one perspective we lever the plan and the asset allocation sums to 140%. That's because we've got 40% in hedge funds. We really don't view hedge funds as an asset class. We view it as a more efficient way to take active risk. So we by and large do not do traditional long-only equity. We generally do not do traditional long-only fixed income. We trade derivatives kind of in a portable alpha context, set aside some cash. The rest is in hedge funds. So we've got kind of a 40% targeted allocation to hedge funds. We tend to run a very diversified book since I'm de facto borrowing money through the derivative markets to fund that. I need my hedge funds to beat the borrowing cost. I've been able to do that net of all fees by 300 basis points annualized over the last 10 to 11 years. But we want negative skew, degrossing events, that worries me, right? So we run about a 40 or a 50 fund portfolio, and we've got relative value, including fixed income relative value, which has been a little bumpy over the last couple of months. We've got the pod shops, we've got multi-strats, we've got trading managers, we've got equity, long short. We've got a little bit of credit that we put in the portfolio as well. But we really view, and we want it to be pretty pure, right? We want kind of a beta 0.15, 0.1 or less. We want the returns to come from skill. We try to, hedge funds are hugely expensive, but at least the managers are quite aligned with you. So we have a 40% allocation to hedge funds. It's a huge part of what we do. We expect 120 basis points of alpha at the overall plan level in terms of the hedge funds outperforming the borrowing cost. That's a big piece of how we get to 7%.
So 120 over borrowing costs, not cash.
Well, right, and that's on 40%, right? So I want my 40% to beat the borrowing cost by 4 percentage points. Okay. I got to put aside 25% cash. So I've only got 75% hedge funds. So that'll give me index plus 3 on 40% of the portfolio. There's your 120 basis points.
Man, that's complexity. Good for you. Edwin, hedge funds.
Yep. Similar, but not exactly the same as you just heard. So again, we don't consider them an asset class. We consider them active strategies. And in that spirit, we run and have been running for years what we call, or the industry would call, an alpha beta overlay. So we have an alpha pool, and that's where our hedge fund book sits. It's $8 or $9 billion in nominal terms, about 7% of the portfolio, and very similar. We have to finance that, and our funds the book overall has done very well. I was a little bit dubious and nervous when the Fed embarked on a fairly rapid increase in that cost of borrowing that the book would face, and it's just done a great job over the last 3 years. Last year, the book as a whole outperformed the cost of financing by about 600 basis points. And again, that's with very little, if any, market beta included. And we're looking to keep that stable now in terms of the overall allocation from a risk standpoint.
Awesome. Jenny?
So we are around 10%, I would say, but similar, like in kind of the typical hedge fund structure. That could tick up. I think the bar is higher. Our performance to date in that area has been mixed. So I think we're a bit gun shy, if you will, about adding there. But I started kind of earlier in my career in hedge funds, so I have a love and a belief for them. But I think it's maybe an easier place to be, a more attractive place to be on that side these days versus maybe last few years. So I could see us ticking up a little bit.
Okay. Dustin?
Yeah, so when I got to UCLA, there were about 40% of the assets were in what I guess one would call hedge funds. Today, that's probably 10 to 12%. I think some of the smartest investors I've come across sit inside of hedge funds, but given what our objectives are and the multiple asset classes we have to do it, I just don't see why they make a huge fit in our portfolio. We tend to see in those maybe we're just bad at picking them, but high correlation to markets, low beta, illiquid assets. So even if they do their job, we can't really rebalance. I don't know. I mean, even in something like portable alpha, I feel like we can carry at over 120 basis points on like investment grade CLOs that are pretty low vol. So putting together a whole portfolio of hedge funds is it's a lot of work for us. We're interested in doing other things.
So I've got two questions on here about markets that you're excited about, and the question of there's a chance of a 50% recession this year. Let's just do a rapid fire. I'm going to give you an asset class. Tell me if you're a buyer, a seller, or just monitor. So not long-winded answers. So Justin, I'm going to start with you. We'll go down the panel. First one, cryptocurrencies, specifically Bitcoin.
No.
Monitor?
Monitor. I like cash flow. So we don't own gold in the portfolio either, so we won't own it.
Jenny?
Monitor from a direct exposure perspective.
Edwin?
Don't buy it for 1 second. If we're not willing to have gold in the portfolio, as a matter of policy, not willing to have Bitcoin. However, we have some teams internally that have been taking advantage of the fact that it's obvious that many investors don't actually understand how the vehicles that give them access to Bitcoin actually work, and been able to take advantage of that and make some money on what we consider arbitrage.
Okay.
Yeah, we've got a pinky toe in that pool, but that's it, right? Bitcoin's been really surprising over the last month or so, right? We saw the price go from 109 down to 78, and that felt about right. But then when everything else was falling, except for gold, you also saw Bitcoin have a pretty strong rally from, what we got from 78 to 96 or so. So we have this is one hedge fund that scaled at about 50 basis points of plan assets, and it's a diversified play. It's Bitcoin plus arbitrage, and that's a space that I like, but it really hasn't done as well as I would have thought. With as much, kind of growth in that space, you would think that there's some inefficiency in pricing there. We haven't been able to exploit that all that much, and then some venture capital plays as well. So we've got a pinky toe in the pool. I don't know if we ever get any more than that.
Lupe?
Odd duck out, as always. We have a strategy called Alpha to Omega that we started to play in almost 4 years ago, specifically directed at crypto and blockchain. Big believers. Other than that, as I said earlier, we really are investing behind megatrends, things that are going to go on beyond the election cycles, like nearshoring in Mexico, digitization of a lot of traditional industries, in particular healthcare.
Okay, megatrends. All right, one more fire round. An odd question. U.S. real estate, buyer, seller, neutral?
It's a big asset class.
Well, I'm going from intangible Bitcoin to tangible.
Buyer. Yeah.
A buyer.
I thought you were going to ask the short questions, but this ties in. So,
Well, you could short it.
a seller of healthcare REITs.
Okay. Edwin?
Selective buyer, willing to increase, again, our overall exposure, but it has to be at the right price.
Buyer as well. If there is stagflation, it's not great for stocks. It's not great for nominal bonds. It could be good for tips. It could be good for real estate. Buyer.
Is that a megatrend, Lupe?
Yeah, absolutely adore real estate, both in being a buyer and a lender.
Wow, that's very interesting. All right. You have to pick between two currencies. Do you want to be long the yen or the euro? Justin?
Euro.
Euro, no question.
Euro.
Got to talk our book, yen.
Oh.
It's way undervalued from any fundamental perspective. The euro is as well, but yen's.
Definitely in the short term, I think the euro's overdone. I'm going to go yen. Yen's bigger undervalue.
I agree.
All right. One more challenge. In 2025, and we asked this question last evening of the young rising stars. From now to the end of 25, is the S&P going to be higher or lower? Or you can pick neutral.
Where are we at right now? 57?
I think
Is that where
so.
we are?
I haven't looked at the market today.
Same, plus or minus 5. Yeah.
Slightly positive.
Yeah,
up a little.
Yeah, maybe up a little bit.
You can have a wild ride between now and then.
Tad higher.
Tad.
I'm an old school top-down valuation person. It's got to be lower.
Yeah, it's probably a sucker's bet, but I'm lower as well.
I would also say lower.
Okay. So I've got a couple specific questions to SWIB and Delta. How do you determine your required rate of return? Is it driven by your underlying asset mix or your growth and liabilities?
I could take that the assumed rate or the actuarial rate of return is actually determined by our sister organization that actually administer. You know, we're an investment board, so we have a different organization that does the pension administration, and they have an actuarial consultant, and that's essentially where that comes from.
Yeah, so formally it's set by the plan sponsor, it's set by Delta, so we just, we have a long sit down with the company and they're like, okay, how much funded status risk, how much, contribution risk do we face if we try to get a 9% return? How about an 8% return? How about a 7% return? And we just kind of triangulate it. It can vary a little bit, certainly depending on what bond yields are at the time, but we settled in at 7, and 7 feels pretty good.
Ours is set by the family and their liquidity needs over the period of time. I would like to say to your prior question, one of the reasons I'm looking at having the year end a little bit lower, we have a great analyst, and she's been spot on the last couple of years on so many things. And one of them is, we've been in a recession, according to her, for some time, that I would agree. And for us to get out of where we are, there's a lot of different things that have to shift. We don't see those things shifting.
There you go. All right, another fire round question. This came from somebody on the iPad. You've got a choice between long term, so not just this year, but long term. Rather be long Europe or China? Justin?
Am I a U.S. institution?
Yes, you are.
Because I don't know what I don't know what the regulatory environment's going to be. But look, Chinese assets are really cheap.
Okay.
Regulatory environment, of course, will play a huge factor. Maybe a little longer China, long term.
Edwin?
Yeah, I'd say longer term. I mean, again, talking our book, we're tilting versus policy. We have a bit of a tilt into EM versus U.S. and versus Europe. So over that longer term, China.
All right, I'm going to make a quick break here because, this is my first Milken ever. I'm excited to be here. It's great to be here. I know there's a lot of great minds, a lot of great thinkers out there. I tried to set up a little bit, kind of in the intro, some of the things that Delta's thinking about, and is there a way to improve the retirement readiness of our employees? So if anyone's out there, Delta puts $1.3 billion into the 401k plan. That's the employer contribution into the 401k plans, $1.3 billion per year. Is it the best thing to just put it into the 401k plan with the fully funded, overfunded, long frozen pension plan? There might be an opportunity to shift some of that surplus to, kind of augment kind of a hybrid retirement plan. Would love to talk to anybody about that if there's folks with thoughts out there. Back to the question, it's a really tough question because I don't really like either all that much, but I think the flow through of Chinese growth to the appreciation of Chinese assets has just been very poor historically. I worry about a top-down, centralized kind of decision-making structure. Europe has got a lot of its own problems that I think stands in the way of multiples and that kind of thing. But given the choice, I'd go Europe over China.
So our head of our pension fund, Mr. Baez, is here in the first table. I recommend you chat with him a little bit about your question. And we have been fans of China for some time. We continue to be fans of China, and I like to say that Mexico, we are the world's amigo.
Very good. Any asset class that you're excited about? And you can answer no, but we've got less than a minute left. So, Justin, I'll start with you.
Yeah, I mean, we're excited about pretty much all of our asset classes. There's always something to do inside of all of those. Like, you can find returns across the board. So there's nothing that, we're excited about all the opportunities coming up.
All right.
I guess biotech would be a huge area that I think
Okay.
I'm super excited about that.
Also super excited, I mean, maybe not surprising, about biotech. The innovation is incredible.
Because things seem overall a little bit, kind of highly priced. If I look at it from an asset class perspective, I have to think about it maybe from an alpha potential generating standpoint, and it's still the case that places like non-U.S. small cap are relatively inefficient markets, as are the China A-share market, and so I think those are the most exciting places, I think, at least from an alpha perspective.
There's certainly a chance that I'm just getting crankier in my old age, but I'm excited about the least amount of stuff that I can ever remember in my career.
Wow. Lupe.
Well, okay. I'm actually extremely excited, believe it or not, in impact investing. And as I think about what's going to happen over the course of the next 10 to 20 years in the transition of capital between one generation and another, and generally one gender and another, these folks really care about clean water. They really care about a lot of things that people my age have really not been focused on. And I think it's gone from being a fad to something that will be very serious. So that's where I'm at.
I hope you're true. Put your hands together. Thank the panel for their time and their interesting comments. Thank you very much.
Thank you, Chris.